What's going on, everyone? Welcome back to the channel. Welcome back to Invest Daily. I hope everybody's having a blessed and wonderful day out there. So today we're going to talk about a little bit of personal finance, right? So generally on this channel, we talk about some collectibles, Pokemon, MetaZoo, market analysis, pricing analysis, stuff like that. But this channel does have a lot more material that I like to put out. So right now, I think it's important that we talk about some other things as well, so you understand how to diversify. If you're pretty new at investing and you don't understand it, we're going to talk about it from a stock perspective today. Just a short video. Today I'm not covering cryptocurrency, but I also enjoy dabbling in that as well. But the reason why I want to talk about stocks, because when I say diversification, that means that obviously I'm not going to put all of my money into one basket. That's what diversification is, whether it's in that same sector, right? I'm going to put in a lot of different cryptocurrencies, a lot of different stocks, maybe a mutual fund, or I'm going to buy a lot of different cards, right? So I also put a lot of money into collectibles, and most of you probably know that by now. I am a long-term investor. You do have short-term investors, but I believe that it's a little bit less risky to hold on to it. And once you lock in that loss, right, that's when you actually take that loss. So right now, we are in the second quarter of negative growth for GDP for the US, which means that most economists are saying right now that they believe that we are in the midst of a recession. It has not been confirmed yet, right? It has not been confirmed that we are in a recession, but that is a big deal. Now, you probably ask, why is it a big deal for a recession? How does that make everything crash? And that's because we go from spending as consumers, and when you start to hear the buzzword recession, a lot of people tend to want to save their money and hide their cash and spend less in the economy, which tightens a lot of things, right? It tightens production. People lose their jobs. A lot of companies lose money. Therefore, they cannot produce and have positive growth, right? And there is no expiration date on a recession. It could be months, it could be years. Right here, we're going to talk about a sound strategy, right? Something that can help you if you want to dabble into stocks. And I think this is very important, but one of the main factors, right? Basically what you can afford to lose. How much time do you have on your horizon? Because obviously as you get older and closer to retirement, you're going to want to be less aggressive in your approach. As you're younger and you can stomach some of those losses, you can be a lot more aggressive, but you also want to be smart about where you put your money. So there's basically two types, right? You have your mutual funds and you also have your individual stock picks. And I say two types because that's basically what we're going to be talking about today. And for your individual stock picks, I would say that's for the person who really understands how to read companies. They understand how to read stocks and understand it. And that way they can make a good judgment on the individual stocks they want to put their money into. Now, if you are going to be doing this, this is a lot more risky. You can have a bigger potential return because it is very aggressive, right? That company can go up really high. It can go down really low. It can crash. Be careful with stuff like penny stocks. But when you're putting into stuff like blue chip companies, and we're talking about your massive conglomerates, or you have, Amazon, you have eBay, you have a bunch of big companies like Apple and stuff like that, then it's a little bit less risky because these companies have been around for a very, very long time. But what you have to understand is that you have to understand when you're actually buying the company to discount and it's the right time to buy in. So a recession is actually a great time to focus on buying, right? Because a lot of stuff is going to go down, and it's going to go down a lot. It's going to go down a lot, and that's across everything, right? We've been talking about that with collectibles and stuff like that as well, and everybody is starting to sell things. They're starting to sell things out of fear, and they're not buying things out of fear. So that way you can get a lot of stuff at a major discount. So when the economy does recover, and it will, it always has, right? It's going to go back up, but you have to play it smart because not everything that you see on sale is a smart buy. Not every company out there is going to last or going to just skyrocket after this recession, once it's confirmed, is over. So the second thing we're looking at is mutual funds, right? So what mutual funds is, it's a little bit less risky, and a lot of you can do that because you're going to be buying into a broad range of stocks. So you have a broad range. Think S&P 500, right? You have the top companies. You're basically investing into all of those companies at one time. When you do that, you're basically lessening your risk. You have a lot of top companies, and that's a great way to diversify. So you don't have to bank on that one company making it. You're basically putting all of your money and breaking it up into a mutual fund so that way you can bank on getting a better return. But now let's go ahead and look at it like this, right? So I want y'all to understand specifically why the stocks fall in a recession. It says typically economic activity declines during a recession. Companies are unable to grow their profits due to the slowdown in revenue. Individuals prefer to save than spend, which in turn affects company revenues. Companies then postpone or cancel capacity expansion or end up with surplus capacity. This in turn freezes fresh hiring or even triggers layoffs, which cascades into weaker sentiment among individuals about spending. Governments earn comparatively low returns from taxes and may thus curtail their expenditure on various projects, which can hinder the company's growth. The stock market reacts when investors anticipate a recession. So just the mere anticipation of this brings the fear, right? And people start to squeeze their wallets. One of the concepts that explains stock price says that it is the present value of future cash flows that a company could earn. A recession would invariably indicate lackluster future sales and hence low profits in return, which will lower the present value of future cash flows, translating into a fall in share prices. So what you need to understand, there is no formula, right? There is no formula to pick the right time and predict the right time to invest. So you have to have the proper investing strategy. So just to wrap up the video, right, we're going to go ahead and break it down with the equity mutual funds and help you understand a little bit better on why this is a good pick in a market like this, especially if you don't have the understanding of the stock market. In this strategy, instead of trying to invest in individual stocks, even if they're available at a bargain, investors can opt into mutual funds. When stock markets recover from a bear phase, which is what we're in right now, the recovery is usually broad-based. Several stocks go up together. Investing in a diversified mutual fund is preferable as investors can benefit from such broad-based recovery rather than betting on a few select stocks. The return from this strategy would be less than that from some of the best performing stocks in the market, but you would still make a great return. However, the risk is also lower than associated with investing in poor stocks that are unable to recover even if the rest of the market does. So by investing in those individual stocks, if it tanks, you're going to lose a lot more money. So a lot of you may be asking, well, how much money can I put into the market? How much can I afford? That is really up to you and what you can stomach and what you can afford based on your financial position. So the best piece of advice, and I say this many, many times and I'll say it again, is you have to dollar cost average. If you don't have a lot of money to put into the stock market or to invest, it is okay. Put what you can afford, but something is better than nothing. I don't care if it's $5 a month, if it's $10 a month, $100 a month, $100 this month and $50 next month, but you want to branch it out, right? You want to dollar cost average. That means that you're bringing your cost basis down. So when all of your stuff starts to go down, but you're buying a stock at a lower price, you're bringing down that cost average, meaning that you bought that whole basket for a cheaper price, right? So you're bringing down that dollar cost average. Then when it starts to go up, you're making a profit. So you do want to make sure that you put a little bit that you can afford each month. And then in the long term, you have to hold it, right? You have to stomach through the roller coasters. You have to know when to sell, because just because the market is going down does not mean it is time to sell, because once you lock in that loss, you have locked in that loss and you have lost your money. So you want to bear that in mind. I hope this helps somebody out there, right? We do talk about investing on this channel. Now, remember, this is pure entertainment. I am not a financial advisor, but I'm just trying to give you some understanding. I'm trying to give you some know-how, because collectibles is not the only thing that you should be investing in, because that is only one piece of the pie, right? So you want to do whatever you can, whether it's real estate, whether it's, stock investing, crypto investing. NFT is very, very risky if you're investing in the NFTs. But there's a lot of stuff out there that you can put your money into. So I love all of you. Thanks for tuning in. I'll be back at y'all for another video very soon, and I'll see y'all later. Out.